A farmer can own millions of dollars in American farmland and still be one bad season away from a serious financial problem. That sounds impossible, but it happens because farming isn't simply a business of growing crops. It is a business of managing money across an entire year. Before a single seed goes into the ground, farmers may already be spending enormous amounts on machinery, fertilizer, fuel, labor, land, and other operating costs. Yet the money from the harvest may not arrive for months. So how does this financial system keep American agriculture moving? Who provides the capital? How do farmers manage debt? What happens when interest rates rise? And how can borrowed money eventually become long-term wealth? Today on Fin and History, we're going behind the fields to uncover the financial engine that helps America's farms operate, expand, and survive.
When most people think about farming, they imagine tractors moving across fields and crops growing under the sun. But modern agriculture is also a massive financial operation. Every season begins with expenses long before revenue appears. Farmers may need to purchase seeds, fertilizer, chemicals, fuel, insurance, machinery, and labor. They also need money for land payments and equipment maintenance. This creates a unique financial cycle where capital goes out first and income comes later. For example, imagine a farmer preparing 2,000 acres for planting. Before harvest, that farmer could spend hundreds of thousands of dollars simply getting the crop into the ground. The farmer doesn't have to generate all that money personally. Agricultural financing can provide the capital needed to begin production. The farmer then expects future crop sales to generate enough revenue to cover expenses, repay debt, and hopefully create profit. This is why agricultural finance is not a side issue in farming. It is part of the foundation that allows the entire operation to function.
Farmers have several possible sources of capital, and each one serves a different purpose. Commercial banks can provide loans for land, equipment, and operating expenses. Agricultural lenders specialize in the unique financial needs of farmers. Government-supported programs can help qualified producers gain access to credit. Farmers may also use personal savings, retained profits, equipment financing, or private investment. Consider a farmer who has built up $700,000 in equity, but wants to purchase a $3 million farm. Instead of waiting years to save the remaining amount, the farmer could potentially use that equity as part of the financing structure and borrow the balance. The lender then evaluates the property, the farmer's financial history, expected farm income, and ability to repay. This relationship allows capital to move from the financial system into agricultural production. Without that flow of money, many farmers would find it difficult to purchase expensive land or operate large-scale farms. Agricultural finance therefore acts like a bridge between financial institutions and America's food-producing economy.
When a farmer applies for financing, a lender doesn't simply look at the size of the farm. The lender wants to know whether the farmer can repay the money. That means examining several pieces of the financial picture. Credit history matters, existing debt matters, farm income matters, collateral matters. Farming experience and future cash flow can also be important. Imagine a farmer requesting a $2 million loan to purchase productive farmland. The lender might ask how much money the farmer already has invested, how much debt already exists, what the land is worth, and whether expected farm income can support the payments. The lender is essentially asking one question: if conditions become difficult, can this operation still survive and repay the loan? This is important because farming revenue can fluctuate significantly. A good year may produce strong profits, while a drought or weak commodity market can quickly change the numbers. Agricultural lending, therefore, requires evaluating not just today's farm, but the farm's ability to handle tomorrow's uncertainty.
Farmland is often the largest financial asset associated with a farming operation, but it can also be one of the most expensive. In productive agricultural regions, large parcels can cost millions of dollars. That creates a major barrier for farmers who want to expand. Financing can make ownership possible, but it also introduces long-term debt. For example, imagine a farmer finding a 1,000-acre property priced at $4 million. The farmer might provide a portion of the purchase price as equity while financing a rest. If the land produces reliable agricultural income and the farmer manages the debt responsibly, ownership could become increasingly valuable over time. But the farmer cannot assume land prices will always rise. Interest costs, commodity prices, local conditions, and agricultural profitability can all affect the financial outcome. This is why farmland should not simply be viewed as dirt with a price tag. It is a major financial asset whose value is connected to both its productive potential and the economic conditions surrounding agriculture.
A farmer can own land and still need additional financing every year. That's because crops require money before they produce revenue. Operating credit helps farmers cover those seasonal expenses. Seeds, fertilizer, chemicals, fuel, labor, repairs, and other costs may all have to be paid before harvest. Imagine a farmer planting 1,500 acres of corn. The farmer may spend hundreds of thousands of dollars preparing and planting the crop, but the crop may not generate revenue until months later. An operating loan can provide the working capital needed to bridge that gap. After harvest, the farmer sells the crop and uses the resulting revenue to repay the financing and cover other obligations. Then the cycle begins again for the next season. The risk is obvious. If yields are poor or commodity prices collapse, the farmer may generate less revenue than expected. Yet the debt still has to be managed. This makes cash flow planning one of the most important financial skills in modern agriculture.
Modern farming requires sophisticated equipment, and that equipment can be extremely expensive. A large tractor, combine, planter, irrigation system, or specialized harvesting machine can represent hundreds of thousands of dollars in capital. Farmers may finance these purchases rather than paying the entire cost up front. But financing equipment creates an important question. Will the machine generate enough economic value to justify its cost? Imagine a farmer considering a $600,000 combine. The machine could allow the farmer to harvest more acres quickly, reduce delays, improve efficiency, and potentially lower certain operating costs. But the farmer still has to make loan payments whether crop prices are strong or weak. If the machine dramatically improves productivity, the financing may make economic sense. If it sits unused or crop revenue falls sharply, the debt becomes harder to support. This is why agricultural equipment isn't simply a technology purchase, it is a financial investment. Every major machine affects the farm's cash flow, debt level, productivity, and long-term profitability.
One of the most powerful forces affecting agricultural finance is the cost of borrowing. Interest rates determine how expensive debt becomes. When rates are relatively low, farmers may find financing more affordable. When rates rise, the same amount of debt can become much more expensive to maintain. Imagine a farming operation carrying several $1 million in combined land, equipment, and operating debt. Even a moderate increase in borrowing costs can add significant expenses over time. That can reduce the cash available for expansion or new equipment. Higher rates can also influence farmland demand because potential buyers may decide they cannot afford large loans. For example, a farmer considering a $3 million land purchase may be comfortable with the payment at one interest rate, but reconsider the deal if financing becomes substantially more expensive. This shows why agricultural finance is connected to the broader economy. Decisions made in financial markets can eventually influence the farmer sitting inside a tractor thousands of miles away.
Farmers don't control the price they receive for many major commodities. Corn, wheat, soybeans, cotton, cattle, and other agricultural products are influenced by supply and demand, global markets, weather, trade policies, and economic conditions. This creates enormous financial uncertainty. Imagine a farmer who budgets for the season assuming corn prices will remain strong. Based on that expectation, the farmer invests heavily in seed, fertilizer, machinery, and labor. But then global production increases and corn prices fall sharply. The farmer may still produce an excellent crop, but receive far less revenue than expected. Debt payments, equipment expenses, and operating costs remain. This is why successful farmers often focus not only on increasing production, but also on managing price risk. Financial planning may involve contracts, insurance, reserves, and careful debt management. The goal is to make the farm financially resilient, even when market conditions change. In agriculture, producing more doesn't automatically mean earning more. The price received for that production can completely change the financial result.
Few businesses face as much exposure to weather as farming. A farmer can plan carefully, spend responsibly, and use excellent equipment. Yet a drought or flood can still damage the crop. The financial consequences can be severe. Consider a farmer who spends $900,000 preparing and planting a crop. A major drought then cuts expected production dramatically. Revenue falls, but land payments, equipment loans, and other obligations continue. This is where agricultural risk management tools become important. Crop insurance and other programs can help eligible farmers reduce the financial impact of certain losses. These tools don't make a failed harvest profitable, but they can help prevent one disaster from destroying the entire operation. From the lender's perspective, risk protection can also strengthen the financial structure of a farm. The bigger lesson is that agricultural finance has to account for uncertainty. A farm's financial plan cannot be based only on an ideal harvest. It must also consider what happens when nature delivers the opposite result.
Government policy plays an important role in America's agricultural financial system. Programs connected to agricultural lending, crop insurance, conservation, and disaster assistance can influence how farmers manage risk and access capital. Some programs are particularly relevant to beginning farmers or producers who may struggle to qualify for conventional financing because they have limited assets or operating history. Imagine a young farmer who has agricultural experience but hasn't yet accumulated enough collateral to qualify easily for a large traditional loan. A government-supported lending program may provide an additional pathway to financing if the farmer meets the relevant requirements. These programs don't eliminate the need for responsible financial management, and loans still generally have repayment obligations. Their broader purpose is to strengthen access to capital and reduce certain risks within an industry that faces unusually high uncertainty. Agriculture affects food security, rural communities, employment, and the broader economy. That is why agricultural finance is not only a private banking issue, it is also connected to public policy.
Debt is often viewed negatively, but productive debt can sometimes help farmers acquire assets they couldn't afford with cash alone. The key is whether the borrowed money supports something capable of generating economic value. Consider a farmer who finances the purchase of productive farmland. Instead of spending several $1,000,000 in cash, the farmer uses a combination of equity and debt. Farm income helps service the loan, and over time, the outstanding balance may decline. If the property also appreciates, the farmer's equity could increase. For example, imagine purchasing a farm for $2.5 million and gradually reducing the loan balance while the property's market value rises. The farmer may eventually own a much larger share of a valuable asset. But leverage also creates risk. If farm income falls or land values decline, the debt can become more difficult to manage. The lesson is simple. Debt doesn't automatically create wealth. Properly structured and responsibly managed debt can help acquire productive assets, but excessive leverage can turn an opportunity into a financial burden. Farmland has something many other assets don't have. It can remain productive for decades while potentially increasing in value. This makes it especially important in discussions about generational wealth. Imagine a family that purchased farmland several decades ago. The farm generates agricultural income every year, while the property may also appreciate over time. The next generation could eventually inherit land representing substantial financial equity. But passing a farm from one generation to another requires planning. There may be outstanding debt, taxes, ownership questions, operating decisions, and family disagreements. If these issues aren't addressed, an asset built over decades could become difficult to manage. Successful farm families often think beyond the current harvest and consider what happens 10, 20, or 30 years from now. This long-term perspective is one reason agricultural finance is so important. The financial decisions made today can influence not only the current farmer's income, but also whether the next generation has a viable farming business or simply an asset that must be sold. Agricultural finance isn't limited to farmers. Farmland can also attract investors who see it as a productive real asset. An investor may purchase agricultural land and lease it to a farmer who operates the property. In that arrangement, the farmer focuses on production while the landowner receives rental income and may potentially benefit from long-term appreciation. For example, an investor could purchase a large farmland property and lease it to an experienced producer under an agreed arrangement. The farmer doesn't need to purchase the land, while the investor doesn't need to operate the farm personally. Both sides have different financial objectives, but farmland investment still involves risk. Rental income can change, property values can decline, and agricultural conditions can affect demand. Location and land quality also matter enormously. Nevertheless, this model shows how agricultural finance connects farmers with a much broader investment ecosystem. Behind America's fields are not only farmers and banks, but also landowners, investors, insurers, lenders, and other financial participants. After looking at the entire system, one thing becomes clear. American agriculture depends on far more than what happens in the field. Land financing helps farmers acquire productive property. Operating credit provides the money needed to plant and maintain crops. Equipment financing supports modern machinery. Insurance helps manage unpredictable risks. Commodity markets determine revenue. Interest rates influence borrowing costs. Government programs can improve access to capital and provide additional protection. And over many years, disciplined financial management can potentially turn agricultural production into substantial equity and generational wealth. Consider the farmer we imagined at the beginning. That farmer isn't simply borrowing money. The farmer is managing a complete financial system that must survive both good years and bad ones. That's the hidden story behind America's farms. The next time you see thousands of acres stretching across the American landscape, remember that underneath those crops is a complex network of capital, debt, investment, risk, and financial decisions. If you enjoyed this journey into the money behind American agriculture, subscribe to Finance History, like this video, and share it with someone interested in farming, finance,